Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty, and I'm doing our housing weekly market update. Let's get my whole head in there. How we doing there? Okay. Um, well, lots going on. We finally got a jobs report for September because it was delayed because of the government shutdown. We won't be getting a report for October. But we should see some inflation reports coming out in about a month. So we'll keep you posted on that. And the reason why that's important is because that's what the market gauges everything on as far as the 10-year treasury, which runs with mortgage rates. Okay. Usually that spread is between now the new average is about 1.6 to 1.8 or so. And what drives that, along with labor and inflation, and it's labor over inflation as far as the Fed is concerned. We've got, by the way, we've got a Fed that's going to be finished, another hawkish Fed that's going to be finished in January, thankfully. And Powell, of course, his reign of terror will be finished in May. But we want more of that dovish Fed. So the good news is we're going to see more of that dovish Fed coming into the mix as far as the voting members are concerned. So that's good. And then we should have a new Fed president, probably named right before Christmas would be my guess. Um, but this report, let's take a quick look at it here, and then I'll get into the details of this because the information is always in the details that are breaking down. So the delayed September report shows U.S. added 119,000 jobs, more than expected. Unemployment rate at 4.4%. Now, the Federal Reserve told us about a year ago that they would be concerned if the unemployment rate was at 4.3%. Now it's at 4.4%. Not only that, but if you look at uh, the last 5 months, the average job growth has slowed to 39,000 a month, 39,000 a month, which is unheard of when you take that whole average over. And then, of course, we had all those other adjustments that came in, over a million jobs that were fake beforehand under the last administration. So this has been the slowest job growth in the 21st century outside of recessions. It's been the slowest job growth in the 21st century. And I've mentioned this before that the economists that met at a recent gathering of economists, basically said the thing that they feel is holding up the market more than anything, it's not the tariffs, okay? It's actually the Fed's fund rate and Fed policy. You gotta keep in mind, people always want to fight me on this. Yes, the bond market's always ahead of the Fed, but it is how hawkish or dovish the Fed is, what the messaging is, like when Powell said, we don't know if there'll be a rate cut, which by the way, all the odds makers right now say there may not be. But if you're looking at the data the way you should be looking at it, yeah, this jobs report came in better than expected, but it isn't anything spectacular. And part of their mandate was to tame inflation, which tames the entire economy by demand destruction. That's what they were trying to do, and they did it too late. Went too high. They've been too long with it, because we know that if we look at inflation, for instance, we know that, and I'll show you this in a second. We know that the current inflation rate is much lower than what's expected, and even Powell admitted that the shelter cost, which makes up a third of the CPI inflation and almost 20% of the PCE inflation rate, it's already come way down, way down. Not that rents aren't going up, but the rate that it goes up for shelter costs and the ridiculous way, that they calculate it, which I mention all the time, with their surveys where they call you up and say, "Do you know how much your home will rent for?" And nobody knows. Um, from the 1980s way of doing it, when we have all these other data points that we can pull from that gives us the real data, like MLS data, through where everything gets syndicated out to places like, for properties that are listed for rent, such as Zillow, Redfin, Realtor.com, all these different sites, and Cotality, there's all these different ways that we have real time data, and they're using all these antiquated models. Powell says, well, we don't have any plan, we don't really know. And I think it's political. As Logan Monashami puts it, he needs his uh his pawns. You're the pawns, we're the pawns. And he will basically be fine with being late to the party here. But along with this, we saw that manufacturing, uh, specialty contracts, jobs are being lost, but residential construction employment improved. Okay. Those two metrics are important. Manufacturing, when manufacturing goes down and construction jobs go down, that's a sign that we're heading into or could be in a recession. We've talked about that before, but I wouldn't be surprised to see those construction jobs getting revised down now. But I think the manufacturing eventually is going to go up, forward looking, but it's going to take, a year, 2 years, 3 years for that to go up, with all the new money coming in for AI plants and all the other manufacturing that we're going to see. It's not going to happen overnight, guys. So we saw, the mortgage rates fell, and then with Powell, they went back up, and then they've kind of been up and down in that low to mid range in the sixes. All we need to do is get to six. If we get to six for a sustained period of time, we're going to see a very big boom. We've got a forecast for next year of 14% increase in home sales. So I would definitely go along with that, because, and that comes from the NAR, and Lawrence Yun over there, who's their chief economist. I would definitely go with that stat. Their stat about the 40-year-old first-time home buyer was a ridiculous survey. Many in the industry questioned that survey because it only basically collected, of over 170,000 people that they sent out surveys to. Only 3.5% actually responded to that. I think we're still kind of in the same neighborhood that we've always been in with the buy down rates. People are actually still able to afford a job when they form a family, and family formation. But the Fed and Neil Kashkari, who's one of the Fed governors, has said this, at the end, I think it was at the end of 2023, where, you get very hawkish. We get very worried with our Keynesian models of economy, and, people are going to be having, family formation. They're going to have sex. They're going to have kids. They're going to buy homes, and they're going to increase inflation by doing these things. And it's a very infantile way of looking at the market. I think we're going to see, and when this dust settles, when the real data comes out, we're going to see. We may not even see any data for October, as far as the jobs numbers are concerned, because of the government shutdown. But the labor market is softening, not breaking. Jobless claims are still very low, but we don't see a recession signaling yet, if at all, with the numbers looking forward. So, for instance, Logan Monashami says, the Fed is very inconsistent with what they're saying. They said they'd worry at this point of unemployment, yet, last year, but now they're just saying, well, we're still going to be hawkish. They're not even in a neutral stance. And then, when you hear neutral or accommodative, that's when the bond market will react in a big way. And they should be reacting to this 4.4% unemployment rate. But we'll see what comes up next month, and how political Powell will be, who secured his seat with the transitory stuff, and then 8 days later went ahead and raised the Fed's fund rate right after that. So the Fed says it's still modestly restrictive, um, and they seem to be determined to stay restrictive until the labor market clearly breaks. Okay, what would that mean? Well, with right now we're sitting at around 240,000 on a 4-week moving average on the unemployment. It would need to be at 323,000, and we'll see what ends up coming out there. I think we may even see revisions to some of this. Um, some of the people in the market basically thought we were at a 4.5% unemployment rate. So we'll see if anything gets revised as we go along here. But the Fed says it's still going to be modestly restrictive. Powell could take a victory lap now and move towards more of a neutral policy rather than waiting for more damage to the jobs numbers. But we'll see. But 39,000 over the last 5 months, guys, on average, that's the worst in the 21st century outside of recessions. So existing home sales and housing, as predicted early this year, there was a shift around June, July, and we saw that existing home sales turned positive year over year from July to November, mainly because forward-looking indicators like purchase application data, which we always talk about, pending home sales improved. Um, right now, we're at like 32 weeks of positive mortgage application data. That gives us a window into the next 30 to 90 days. So no surprise there, like we always talk about. And the housing wire that I follow as one of my data points, they have a tracker, and every week they put this stuff out, guys. And these are real hard numbers, the best numbers that could possibly come out. They're not the headline clickbait numbers that you get a lot of time from places like Redfin, like the biggest, buyer seller gap in America. And then they revise their numbers down like they do every year at the end of the year. It's great for clickbait. I get it. It's good for marketing, good to get people driven to the site and to look for it, but it's not reality. Not that things, the affordability issue is a thing, but I think we're still kind of in the range of 30 to 35, probably for the first time home buyer, not 40. But and that's kind of where Logan over at Housing Wire looks at it. Logan also points out something that most people don't realize, but every month, you've got about 1.5 to 2 million people that lose their jobs, just on a rolling average or a range. Um, so, whether or not they actually apply for unemployment, make a quick lateral over to another job, that's a whole nother matter. Start a business, whatever. But the Fed, this is where the Fed is with basically rudderless, no direction. So, but the existing home sales mortgage rates, it needs to spend time. If it spends any further length of time in the low sixes, or we're in the high fives to the mid six range, 6.5 range, it'll be better than last year's 7%. Okay, 7% plus actually. So weekly pending sales are up 15%, uh, and they're up year over year 15%. Purchase apps 3-week average are up 28%. We had a let me just share this here with you really quick. We had the mortgage applications just this past week were the strongest week since September that we had. Buyers are taking advantage of easing prices, economists say. Okay, not to say that prices are crashing, but I think even more than this, it's that they can get these buy down rates right now. That's the biggest thing, is the payment, right? So they're looking at these ARM loans. They're looking at seller or builders paying down interest rates to fixed rates in the threes and fours on incentives that they're offering, paying closing costs, all kinds of incentives that they're giving right now at new home builds, and on resale homes. A lot of people are having to give up incentives. Right now, in the greater Phoenix area, we're running just right around 97.8%. So on the the list to sales price ratio, we're actually seeing more buyers in the market with properties going under contract. And I'm sorry, I forgot to pull up the chart here, but we're at about 75 days on market, and that uh, number of homes going under contract and actually being sold has actually gone up. So we're seeing more buyers in the market. And this is really the best time of the year to be in the market always, because you can typically get better deals at the end of the year from builders, from sellers. Maybe the home's been on the market a little bit longer. So we typically see that anyway, but especially in a market like this. So, um, home prices are not crashing nationally. Medium prices are up every month this year through the pace of growth. The pace of the growth has cooled a little bit, which, slowly helps affordability, but they're not, down. And, the credit quality of homeowners is definitely strong. And as Logan Monishami points out, definitely he sees a healthier, more balanced market than pre, 2008. Okay. We don't have the amount of inventory. We have pre-qualified um, buyers, which was much different than back then. We have people with, right around $300,000 in equity, on average. Mortgage rates have come down to the point to where just out of the box, without even getting the buy downs, the payment on average for the average home is down about $300 a month. So there's definitely a lot of positive things moving forward, and it's only going to get better if rates drop. We just need it for a sustained period of time, and that's why we're seeing this. It's a reaction to these lower rates compared to last year being over 7, where they're just a longer sustained period of time. That's the big thing. Not just getting rates low like we've seen over the last couple of years, but staying low. Okay. For a sustained period of time, 12, 18 months. That's what we really need to see. So, um, housing definitely isn't the Fed's mandate, but it certainly affects pretty much every sector of the economy in many ways. When you stop and analyze, when people buy a home, all the things that go into building that home, built up around that community, what people have to do in order to live in that home, buy food, buy goods, construction costs, remodeling costs, landscaping, all those different things that go into owning a home, and all the maintenance that goes into it. So, um, he thinks that the Fed fears a housing rebound with the current leadership, which is going to be changing soon. When the mortgage rates hit 6%, the Fed gets a little weird with that whole thing. So it's the doomer commentators and some on Wall Street that have these narratives, and poor models. Okay, like Logan always points out, show me your models, and let me backtrack on those, and see how those actually kind of work out. So um they don't, this idea that you have price declines doesn't match the NAR data. It doesn't match the Case-Shiller data. It doesn't even match the Redfin data when they've revised their numbers like they do at the end of every year, and they fake you out with the clickbait. uh, some metro areas are certainly down a little bit, but not the whole country. And a crash is not, a slowdown in the rate of increase, or going down 0.5% or 1% when you've had all these equity gains over the last, 4 or 5 years. It's just not. So it's interesting when you hear some of these people talk anyway. So um, one of the oh, I just wanted to show you guys some of this. 2005 BK reform law, it changed everything for the better. Logan says foreclosures and bankruptcies are still below pre-pandemic levels. You can see where they were here during the crash, and where we are today. Of course, they did go up after COVID because you had all the forbearance and everything going on. Oh my God, it's up this percent, but it's still lower than it was pre-pandemic. Okay. Uh, you're always, foreclosures you will always have with you. Well, they're like Jesus in that way. Uh, but we're going to make housing great again. Don't you worry. Growth in the existing home sales from Mike Simonson. He's the chief economist. He used to be at Altus Research. He's now with Compass. Logan Moshami agrees. It says home sales for the October growth is no surprise. The weekly pending home sales data has been up reliably for months. NAR seasonal adjustment math has always been a bit opaque to me, though. The last year, December had a huge lift, maybe from September. Um, and he says, the report seasonally adjusted sales in November and December better than 2025 than 2024. From the raw data, it looks like they should, but again, I'm not confident in their seasonal adjustment. So we'll see. We'll see how this all shakes out as we go along. Existing home sales right there. Can it last through the end of the year? We'll see. Um, the oh, I just jumped ahead here. Sorry about that, guys. Okay. So if Goldman Sachs is right, October would be negative 94,000 jobs versus last year, because Goldman Sachs came out basically with some jobs numbers based on their analytics, and that's what they're seeing for October. We don't have October numbers from the BLS, so you can take that for what you will. The ADP, everybody, got a little excited about the ADP being so wonderful, but if you look at the overall numbers, they're not that great, guys. They're not that great. Okay. I'm telling you, the Fed changes policy. This all shifts. Just watch. Now it takes a good 6, 12, 18 months for whatever they do in their policy to really shift things. But just that messaging, we're going to see a shift in the bond market, 10-year treasury, and thus mortgage rates, 30-year mortgage. Labor data much worse this year versus last year. Here's a sector breakdown, which we pretty much already covered. Um, and this is interesting. Employment of native-born Americans was up 2.5 million in September, year over year, while foreign-born employment fell 670,000 year over year. Okay. U.S. Labor Department published the September jobs data end of November, but it registered a surprising uptick of 119 non-farm payroll, 50,000 above expectations. Okay. Although we see an uptick in unemployment over the past 2 months, they're mentioning 2 months there. This is interesting. I thought you guys might like this. Um, this is the Fed sheet, and EJ Antoni says, I wish I too could lose 245 billion on their sheets and still keep my job at least until May. He's referring to Jerome Powell. So that shows you how incompetent Jerome Powell is. Okay, just in a nutshell, right there. Not to mention everything else going on. So manufacturing activity accelerates again, putting it the best reading over the past 3 years. Production also expanded at best pace in just as long. Unemployment expanded, inflationary pressures moderate, though they remain elevated. So, and here's the existing um, home sales numbers. They rose 1.2 million month over month. I'm sorry, 1.2% month over month in October, as low mortgage interest rates brought at least some relief to home buyers. Median sales price was up 2.1% year over year to 450,200, while the average price was 558,600. Home sales were at an 8-month high, but still near record lows. So better, but nothing fantastic from very low levels, right? So we'll see. Waller continues to lay out the case for cutting rates. The labor market is still weak, near stall speed. A December cut will provide additional insurance against an accelerated in the weakening of the labor market. But it's like they're playing catch up. Okay. They're playing catch up. Trueflation. As of today, I trust Trueflation more than I do Jerome Powell. And some of the BLS numbers that we get or don't get. in a timely fashion from the government. They hit more data sectors. If you go back on their website and you look at their charts, they're right on the mark every time. Um, BLS confirmed there won't be October U.S. inflation will be released November. CPI will be delayed until December 18th. The Fed should move their meeting past that mark, but they probably won't. Um, and that's straight from a lot of economists, including Logan Monashami. Trueflation, U.S. inflation CPI today is at 2.41%. U.S. PCE today, 2.36%. And U.S. inflation aggregated since January 2020, 28.42%. So, um, you know, I wanted to bring this up again because still a lot in the works there. And the 50-year mortgage too. Let's just talk about that. Um, I think again, you're better to have more options than not. I think that it's definitely good to have the option of more than less, of course. But an example of a $300,000 loan on a 30-year cost, 369,000 in interest. At 50 years, it's 755,000. So a lot of people are arguing about this. Whether or not it'll even happen, we'll have to wait and see. Along with the FHFA eyes on assumable and portable mortgages. Here's the thing, guys, with whether it's the 50-year, whether it's a portable mortgage, there are assumable mortgages already. You can assume somebody else's low rate. But the portable mortgage, the problem with this is there's already terms written into people's current contract. So, in order to change that, you'd have to get the bank and Congress to basically allow these to be portable. You have to change the law, the terms. So, it's more really probably of a moving forward type thing, which will be good, future. But, as many people point out, the idea of a portable mortgage, yeah, it's called paying off your debt. Um, and they do have portable mortgages in places like Canada and stuff. But a lot of people don't think that this is a great idea. I think if it's done correctly, it could be a wonderful idea. Um, you'd have to kind of see what the details are, what the penalties might be, what the fees may be. All that's kind of up in the air. So we'll have to see. But it could, ease a rate lock effect if it's changed for the current. We'll have to see what that looks like. Nobody really knows until they kind of hash out all of the differences there on that. So we'll have to wait and see on that, guys, on what where things are. But as far as the 10-year Treasury, uh, it ended today at 4.0. And so our mortgage rates, if the spreads between the 10-year Treasury and mortgage rates were correct, we would be below 6 right now. The spreads have gotten better though. If these spreads were not as good as they are this year compared to last year or a couple of years back, boy, we'd be in a much higher spot. We'd be, closer to 7. But right now we're at 6.3 today. We ended the day at 6.3. That's the average 30-year fixed. You can get lower rates than that with the buy down rates sellers, builders pay for. Um, you can get 7-year arms right now. Builders are offering a lot of incentives, like I said earlier. Let's talk about your options, okay? There's a lot of different ways that we can say, what is the payment you want? And we can negotiate that in the contract, and they're going to say yes or no, or a builder will be offering lower interest rates right now. I've seen fixed rates in the 3s and 4s. Okay, I've seen buy down rates as low as 1.99% first year, second year 2.9, third year 3.9. So they're out there, guys. There's ways to do this. But that's where we ended the day at 6.34. Um, we kind of had that momentum until Powell talked at the last presser. So we'll see what happens at the next one. And we'll keep an eye, on obviously what's going on with the labor market. But um, the the demand in the Phoenix area, like I said, has gone up. There's more buyers out there right now, so that's good. Nothing crazy, but it just, it's definitely gone up. The greater Phoenix area right now, we're in a buyer's market. This time of year, very seasonal. A lot of homes come off the market. um, or temporarily off market. We see that the supply is still elevated though. Okay. It's over that 100 balance point, compared to the demand. So it's ticked up just a little bit, but not anything crazy on the demand side. And anything below, so 90 to 110 is a balanced range on this index from Cromford. 100 being completely balanced. Below 90 is a buyer's market. And again, every community, every zip code, every local area is going to be different. But overall, in the greater Phoenix area, we're at 78.8%. That puts us in a buyer's market right now. So, you know, that's really appears that, inventory appears to be following last year's seasonal decline pattern, but it's still elevated compared to the demand. So that's all I've got for you this week, guys. I hope that helps. If you have any questions at all, please feel free to reach out. I'd love to be able to help you figure things out, whether you're looking at buying or selling. We could certainly talk over numbers, at least have a consultation. We could talk about, what your home values look like in your area, break down a whole net sheet, um, with a little bit of a spread in a pricing range, what that looks like going into the new year, where you're thinking about now or next year. It's a good time to start getting on top of these things now. Even talking to a loan officer right now, it's a great time to start planning ahead and not waiting to the last minute. I know a lot of people are, into the whole holiday mode right now. So am I. Love this time of year, right? Spend time with family. But thinking ahead is always a good thing. We can talk about what we would need to get, going as far as getting your property sold, give you some idea what's going on in the market. Zestimates are not accurate, guys. They're just not accurate. And there's a lot of misinformation out there, a lot of AI information out there, and the doom and gloom or clickbaiters. So reach out to us 480-788-8569 or check us out online, and we'll talk to you guys next time.